Imagine waking up to this headline: President considers invoking the Insurrection Act. Before you even finish reading, stock futures dip, volatility spikes, and investors start moving into defensive assets. So, what is the Insurrection Act and why do markets react so strongly whenever it's mentioned? The Insurrection Act is a US law passed in 1807. It gives the president the authority to deploy federal troops or the National Guard inside the United States under specific circumstances. Those circumstances include situations where states are unable or unwilling to protect constitutional rights, when domestic unrest overwhelms local law enforcement, or when federal law cannot be enforced through normal means. This law has been used before, particularly during the civil rights era and in moments of large-scale unrest. So the existence of the law itself isn't new. What's new is how heavily charged it feels in modern political and economic environments. Markets don't trade on legal nuance, they trade on uncertainty. When investors hear the words Insurrection Act, they're not thinking about an old statute or its technical requirements. They're thinking about political instability, social unrest, disruptions to business, and the possibility of unpredictable government action. That uncertainty is what causes markets to react. Historically, political unrest tends to trigger a familiar market pattern. First, there's a short-term sell-off, especially in riskier assets like growth stocks and consumer-focused companies. Then volatility rises as traders rush to hedge. After that, capital often flows into safer assets such as US treasuries, cash, and sometimes gold. At the same time, certain sectors like utilities, defense, and essential services may hold up better than the broader market. Importantly, these moves are often driven more by emotion than by long-term fundamentals. What markets actually care about isn't the Insurrection Act itself, but the conditions that would make its use necessary. Investors are trying to gauge whether unrest is temporary and contained, or whether it points to deeper political fractures and prolonged instability. Even the possibility of invoking the act can move markets because markets are constantly pricing what might happen next. When headlines like this appear, investors tend to focus on a few key questions. How long could the unrest last? Is it limited to one area or spreading nationwide? Are government institutions aligned or openly in conflict? And will there be real economic consequences like supply chain disruptions or labor issues? Those answers matter far more than the headline itself. In the end, the Insurrection Act isn't a market signal on its own. It's a stress test for political stability, institutional trust, and investor confidence. Markets don't panic because troops might be deployed. They react because uncertainty is rising, and uncertainty is always the first thing markets price in.